Thanks for joining me, Michael. I appreciate it. Could you tell me a little bit about yourself and what you do as a mortgage broker, and then maybe even how you relate to Salt Financial Group?
Yeah, for sure. First of all, thanks for having me on the video. So my name is Michael Laws. I'm a mortgage broker and I'm the owner of a business called the Circle Finance Group. We specialise in residential lending, and we've been in operation for a little bit over 12 months. I've actually got more of a financial planning background, but I pivoted and started a mortgage broking business instead, primarily to partner with firms like yourselves. So I know the great value that financial planning firms offer their clients, and having had a good relationship with Salt in the planning space, I decided to work closely with firms like yourself because there's a natural gap in the planning offering, in that you can't advise on lending strategies and things like that with clients. So I quite enjoy partnering up with financial advisors. I understand the work and the great work that you do with clients, and hope to complement that with strategic mortgage broking advice for clients that want to purchase, whether it might be their first home, it might be a subsequent home or an investment property, or look to renovate their existing property.
Yeah, it's good that you got the financial advice background. I'm sure that would relate a lot to the mortgage broking, like the full picture of financial advice.
It certainly does. Yeah, I think understanding the whole financial world is really complements the work that you do, and I think the clients appreciate that I do also understand that side of things, as well as there's some more complex type of lending through self-managed super funds and things like that. So I do understand that world quite well. So I think it ties in pretty well.
Yeah, definitely. So I'm going to go to a personal question. What was the first investment you've ever made?
Yeah, good question. Unfortunately, not Apple shares. That would have been a good one back in the day.
Yeah.
But yeah, look, I was always a bit of a money nerd, I think, when I was younger. I started working at a very early age, just doing the local paper round
Oh, very
for
nice.
the Moorabbin Standard back when I was probably 11 or 12, and
Beautiful.
then worked at Macca's from 14 to 9 months. Literally the month I could start working as a junior, I did. And it was always a great saver. I think that came down to my mum, who always had her different money boxes where she saved her coins that would pay for holidays and things like that. So I'm sure at some point in the younger years, I had a term deposit that would have been set up by my mum,
Okay.
but I probably won't include that one. When I first started my first full-time role, there was a financial advisor that worked there. And so I'd saved up a bit of money to go overseas, and we deferred that trip by a year. So I actually just used that money and spoke to the advisor, and we invested that into an MLC platform.
Yeah.
So that was into a bunch of managed funds and things like that.
Yeah, that's good first investment.
It was good. Yeah, it was actually cool when I was traveling around. I would have been 23, 24, 25, traveling around Europe, and you can look online and see it grow. And
That's
I
it. Yeah.
suppose by the time I came home, almost the trip had paid for itself with the growth that had been made in that investment. So yeah, so it certainly sparked my interest in investments long term, that
Yeah.
first foray into the markets.
So what factors do lenders consider when assessing a mortgage application?
Yeah, well, there's quite a few. It's obviously a very important process, and one that requires a fair bit of paperwork and due diligence on behalf of the lender and the broker. So there's probably four main areas that a lender is looking at. And the first one would be really the borrower's ability to repay the loan. So
Yeah.
what the lender is looking at there is things like your income, your expenses, any other debts that you may have, your employment history, things like that. Just making sure that when you do borrow a substantial amount, that you do have the ability to repay it. Next, I would look at the property itself. So the property is being used as security for the loan. So that means that if you were to default on the loan, or the borrower is going to default on a loan, then the lender can actually then repossess that property and sell that to recover their losses. So they want to make sure that the property itself is typically a good quality property that can be resold at some point in time should the worst happen. So you'll find that some lenders don't lend against very small units, say under 40 metres squared, for example, or in some rural areas, because those properties just may not be as easily sold as your standard residential types of properties. The next one they'll look at is your credit history. and what they're going to look at there. They'll look at your credit file and run a credit report and your credit score and assess whether or not you've got a really good record of paying existing sort of bills, loans and things like that. And if you've had a history of defaults, certainly if you've ever been bankrupt, things like that, then you're really going to struggle to get a loan. And then lastly, they'll look at what sort of deposit or capital that you've got saved up that you can contribute to the loan as well. So particularly for first home borrowers, they want to see that you've actually got some strong savings history and you can build that deposit. And the deposit is a big factor in qualifying for a loan. Typically, most borrowers would contribute around 20% of the purchase price to the loan. There are some circumstances, whether it's lender policy, if you're a medical professional or a legal professional or something, you might be able to provide a lower deposit without having to pay lender's mortgage insurance. And there are some first home buyers options as well where you can get in for as little as a 5% deposit. But typically the larger the deposit, the lower the rate that you're going to pay because discounts start applying for the lower the loan to value ratio on the loan.
Would you ever advise someone to go beyond that 20%?
To pay a larger deposit than the 20%? Yeah. Look, for time to time, if a client can do it, certainly, because if they've got the cash there, and it happens quite a bit if someone's selling an existing property, they've got a large pile of cash, $1 million plus potentially, and then they want to borrow a little bit extra to buy a slightly better home. So in those situations, they might contribute 60 or 70% and just want to borrow a bit of a top up. Typically, if you contribute more than 40%, you'll be on the best rates that lenders will offer because it's that 60% loan to value ratio where the best rates really kick in. It all comes down to personal circumstance, to be honest. If you want to free up your capital for other purposes, you might want to contribute the bare minimum to the property, so 20%. And then you might have several $100,000 that you might want to invest elsewhere, potentially in another investment property and use that for a deposit for that, or maybe with your financial advisor, they may want to invest in shares or manage funds or some other investment, or just have it as a cash buffer. So it's really horses for courses. We have a really solid in-depth chat with our clients around what they want and what their medium and long-term financial goals are, and we'll tailor a lending strategy that's most appropriate for them, taking into account their sort of all their long-term requirements and objectives.
Yeah, no, that makes sense.